Welcome to this deep dive. I'm your host, and sitting across from me today is our resident financial strategist, ready to unpack some seriously dense material. And when you look at a classic optical illusion like that famous drawing that's either a duck or a rabbit, depending entirely on how your brain processes the lines, there's this really profound moment of cognitive dissonance.
Oh, absolutely. Yeah, I'm thrilled to be here.
Thanks for joining. Because, you see the duck and it's clear as day, the bill is pointing left, and then suddenly your perspective shifts. The duck's bill becomes a pair of ears, and you're staring at a rabbit facing right.
Yeah, the human brain is just incredible at that. It looks at the exact same data points, right?
Yeah.
The exact same ink on the page, but it constructs two entirely different realities based on, well, whatever context it decides to prioritize in that moment.
Right, and that phenomenon is just the perfect way to describe the absolute puzzle we're unpacking with you today. We've pulled together a massive stack of sources for this one. We're talking earnings call transcripts, financial analyst notes, long-term strategic roadmaps.
It's a lot of paper.
It is a ton of paper, and it's all centered on PayPal's second quarter 2026 earnings print. And I'm telling you, consider this your personal briefing for what has become the ultimate institutional Wall Street debate. Because depending on how you look at the math inside these documents, you either see a duck or a rabbit.
Yeah, the dual narrative happening in the financial sector right now over this is just fascinating. You have one camp of analysts, and they're looking at the headline numbers, the adjusted earnings, and they're celebrating a massive, successful turnaround.
Right.
But then you have another camp peeling back the accounting layers. They're looking at the raw transaction margins, and they see a legacy fintech company that is fundamentally shrinking.
Exactly. So the mission for our deep dive today is to get to the bottom of that exact mystery. We need to figure out how a legacy giant like PayPal manages to post a shrinking net income, meaning they actually made fewer dollars in profit, yet they still beat Wall Street's earnings per share expectations.
And watch their stock rally on the news, too.
Right. Stock rallied. So are we just looking at clever financial engineering here? Or are we witnessing the messy early stages of a brilliant AI-driven product turnaround spearheaded by their CEO, Enrique Lores?
To figure out where PayPal is going, we really have to start by dissecting that illusion. We need to look at the headline numbers that had the market cheering and then break down the specific accounting mechanics that made those numbers possible in the first place.
Okay, so let's start with what some analysts in our sources are explicitly calling the earnings per share magic trick.
Magic trick.
Yeah, because on the surface, the headline beat looks fantastic. Their non-GAAP earnings per share came in at $1.38. That handily beats the $1.28 consensus that Wall Street analysts were projecting.
A solid 10-cent beat.
And revenue also ticked up 5% to $8.68 billion. So if you just read the top line of the press release, your immediate assumption is that business is booming. But the deeper you read into the actual filings, the more complicated the story gets.
Because underneath the hood, the actual net income, the real profit dollars the company generated, shrank by 11 to 12% year over year.
Which is a huge drop.
It is. And the operating margins tell an even starker story. Non-GAAP operating income fell 8% down to $1.5 billion, and their operating margins contracted by 248 basis points, dropping down to 17.4%.
Okay, wait, let's put that in plain English for a second.
Sure. Basically, for every $100 PayPal processed, their actual profit dropped by nearly $2.50 compared to this exact same time last year.
Okay, so that raises a glaring mathematical question. If the total profit pool is shrinking, right, and the amount of money you keep from every single transaction is dropping, how on earth does your earnings per share go up?
It all comes down to a really aggressive strategy of capital allocation. Specifically, PayPal executed a massive stock buyback program.
It was massive.
Yeah. In the second quarter alone, they spent $1.5 billion to repurchase their own stock on the open market.
$1.5 billion in a single quarter.
Exactly. And by doing that, they effectively retired 33 million shares in just a 3-month window. And they aren't stopping there either. The sources note they're targeting a massive $6.7 billion in total buybacks for the full year of 2026.
Okay, so mechanically, earnings per share is just a fraction. You take the total profit, let's call it the pie, and divide it by the number of shares outstanding, the slices.
Right.
If the total pie is shrinking by 11%, the only way to make the individual slices look bigger to investors is to literally throw away 33 million slices. You just reduce the denominator.
That is the exact mechanism.
Yeah.
By aggressively reducing the number of outstanding shares, they engineer an increase in the earnings attributed to each remaining share.
It feels a little, I don't know, sneaky.
Well, it's important to contextualize this, right?
Yeah.
This strategy isn't illegal. It isn't even uncommon for mature tech companies. Boards authorize buybacks when they believe their stock is fundamentally undervalued by the market and when the business generates a massive amount of free cash flow.
Which PayPal definitely does.
Oh yeah, they generated $1.8 billion in adjusted free cash flow this quarter alone. But from an analytical standpoint, leaning this heavily on buybacks, it does mask the underlying operational reality of the business.
See, I'm going to push back a little on the framing that this is just standard corporate playbook stuff. Isn't this strategy basically like bailing water out of a leaky boat just to keep it afloat?
The leaky boat.
Yeah. Like, sure, the passengers, the current shareholders aren't wet yet because you're bailing water fast enough with these buybacks, but there is still a massive hole in the bottom of the boat. Is this just a temporary illusion to buy the CEO some time to figure things out, or is this actually a prudent use of capital while they restructure?
Well, I would argue it's less about bailing water out of a sinking ship and more about securing the passengers while you completely rebuild the engine mid-voyage.
Rebuild the engine, okay.
Yeah, because if the management team knows they're executing a massive restructuring that will take 2 to 3 years to really bear fruit, buying back stock while it's cheap is a way to reward the investors who stick around for the painful part.
That makes sense.
However, the bear argument in our sources echoes your concern exactly. You're buying time, but if you don't fundamentally fix the leak in your profit margins, eventually you just run out of free cash flow to fund the buybacks. And then the illusion breaks.
Which brings us directly to the leak itself. We need to identify exactly where this margin pressure is coming from, because if you look at the data, it's not a volume issue.
No, not at all.
Total payment volume, like the actual sheer amount of money flowing through PayPal's networks globally, is up 10% to a staggering $486.4 billion. People are using the network more than ever, so why are the margins taking a nearly 2.5% hit?
The issue is rooted in what analysts call the two-speed engine problem.
Two-speed engine.
Yeah. PayPal isn't just one uniform payment processor anymore. They're basically running two distinct businesses that are growing at vastly different speeds and, crucially, with vastly different economic models.
Right.
So the first engine is their historical high-margin business, traditional branded checkout.
That's the classic gold PayPal button you click when you're checking out at an online store.
Yes, exactly. And when a consumer clicks that gold button, PayPal commands a premium fee from the merchant. They can charge that premium because PayPal owns the direct relationship with the consumer, right? They bring the buyer to the table.
Right, they provide the trust.
Right. But the data shows this high-margin engine has effectively stalled. On a foreign exchange neutral basis, branded checkout volume only grew by a really sluggish 2%. It's stabilized, sure, but it isn't driving growth anymore.
Okay, so if branded checkout is like a boutique retail storefront, lower volume but incredibly high markups, then engine number 2 is their wholesale business.
That is a great way to think about it.
Yes.
Engine number 2 is Braintree.
Braintree. Yeah.
This is PayPal's unbranded back-end payment processing designed for massive enterprise merchants. When you buy something on a major corporate website, you might never see a PayPal logo. You just type in your credit card, and Braintree handles all the complex plumbing behind the scenes to make the transaction actually happen.
And that Braintree volume is surging.
It's surging. It grew in the mid-teens this quarter, up 13% year over year.
The problem with the wholesale business, though, is that giant enterprises negotiate ruthlessly. I mean, if a massive retailer is pushing billions of dollars through your pipes, they are going to demand rock-bottom fees.
Oh, they negotiate those fees down to the absolute bone. So even though Braintree is driving a massive 13% increase in volume, it commands a much, much lower fee per transaction than the branded gold button.
Ah, so there's the squeeze.
Exactly. As Braintree becomes a larger and larger percentage of PayPal's overall volume pie, the average profitability of a transaction inevitably drops. This mix shift, trading high-margin boutique sales for low-margin wholesale volume, is the exact mechanism causing PayPal's transaction expense rate to expand to 0.9% of total volume.
Wow. It feels like they're caught in the classic retail trap. You know, you try to make up for shrinking margins with sheer volume, but you end up running twice as fast just to stay in the exact same place.
Yeah. And escaping that trap requires a total shift in product strategy. But to make matters worse for investors trying to evaluate this quarter, That core margin squeeze was not the only thing dragging down profitability.
Oh, right, the crypto thing.
Yeah, there was another hidden anchor in this earnings print that perfectly highlights the chaos of managing a modern corporate balance sheet.
We absolutely need to explain this crypto footnote because it completely derailed their JAP earnings, and almost nobody is talking about it.
It's wild. Buried deep in the financial filings is a detail that caused a massive swing. PayPal experienced a 7-cent per share drag from its strategic investment portfolio and crypto assets held for investment.
Okay, to put that 7 cents in perspective for everyone, we have to look at the difference between GAAP and non-GAAP accounting. Non-GAAP is the adjusted, slightly rosier picture that management likes to present, which strips out one-time costs.
Right, the $1.38 number.
Exactly. But GAAP, generally accepted accounting principles, is the strict, standardized way the government requires you to report your finances. Their GAAP earnings per share was only $1.25. So that 7-cent drag accounted for a massive chunk of their overall 3% decline in GAAP earnings.
And it gets crazier.
Right, because a year ago, in Q2 2025, they had a 1 cent benefit from those exact same assets. That is an 8-cent swing year over year, entirely outside of their core business operation.
Yeah, it's a huge swing, and mechanically this happens because of fair value accounting rules. PayPal facilitates crypto transactions, right? And they hold digital assets.
Right.
So if the broader crypto market takes a hit and the price of Bitcoin drops during a specific 3-month quarter, accounting rules force PayPal to mark down the value of their holdings to the current market price.
Even if they didn't sell anything.
Exactly. They have to record that drop as a paper loss on their income statement, even if they haven't actually sold a single Bitcoin. It essentially transmits the extreme volatility of the crypto market directly into PayPal's quarterly operating metrics.
How is an institutional investor supposed to digest that? Like, does this mean their crypto exposure is just unavoidable accounting noise because of the specific services they offer? Or is it a sign of a massive operational distraction when they should clearly be focusing all their energy on fixing the checkout margin squeeze?
Well, the analyst notes we reviewed tend to view this primarily as a treasury and accounting quirk, rather than a fundamental flaw in the core payments business.
Okay, so more noise than signal.
Yes, but it absolutely creates noise. And that noise clearly bled into management's ability to forecast the future, resulting in some very, very confusing guidance.
Oh man, the Q3 guidance misstep was baffling. Let's walk through what happened there. In the official press release that went out to the market, PayPal projected a low single-digit EPS decline for the upcoming third quarter.
Right.
But then, an hour later, on the actual earnings call, the CFO verbally guided for a low double-digit decline. For a multi-billion-dollar financial institution to issue conflicting guidance between the written release and the verbal call, that is a massive communication failure.
It really is. It caused immediate whiplash across trading desks. People didn't know what to do. But the silver lining that stabilized the stock is that despite the short-term confusion for Q3, management expressed enough underlying confidence in their turnaround to actually raise their full-year 2026 non-GAAP EPS outlook to approximately $5.38.
Okay, so let's follow that logic. To justify raising that full-year guidance to $5.38 and to offset the margin squeeze from Braintree we talked about, they desperately need a high-yield growth engine to kick in immediately.
Okay, yeah.
And according to the strategic roadmap, that engine is Venmo.
Venmo is the absolute linchpin of their monetization strategy. Because for years, Venmo has been a fantastic, ubiquitous utility. You know, people use it to split dinner, pay rent, send a few bucks to a friend.
Right, it's a verb. I'll Venmo you.
Exactly.
Yeah.
But mechanically, as a peer-to-peer transfer mechanism that's usually funded directly from a linked bank account, it is essentially a zero-margin business. PayPal does not make money when you send $20 to your roommate.
It goes back to the classic razor and blades business model.
Right.
You hook the consumer by giving them the razor for free, and then you make all your profit selling the replacement blades. PayPal hooked hundreds of millions of users with the free razor of frictionless peer-to-peer transfers, and now they're finally trying to sell the blades.
And the data in this Q2 print prove that those particular blades are incredibly lucrative. The standout metric the analysts highlighted is what they're calling the 9x lever.
The 9x lever, let's dig into that.
Okay, so when a Venmo user transitions from just sending money to friends to actually getting a physical or digital Venmo debit card and swiping it at a store, they generate 9 times more revenue than a standard peer-to-peer user.
9 times more revenue from the exact same user just by shifting their behavior. That is a staggering jump in customer lifetime value. How does the math on that actually work?
It all relies on interchange fees. Every single time you swipe a debit card at a coffee shop or a grocery store, that merchant has to pay a small percentage fee to the card network just to process the transaction.
Right.
Well, because Venmo is issuing the debit card, they get a cut of that interchange fee. So suddenly, a user who is literally costing them money to maintain is generating passive income on every daily purchase.
That's huge.
It is, and the transition is working. Venmo debit monthly active accounts jumped over 50% this quarter. They are successfully mutating Venmo from a simple transfer app into a high-margin, daily-use financial hub.
And the strategy documents call this ecosystem layering. They aren't just stopping at debit cards, right? They're weaving entirely new financial services directly into the checkout flow. A major example from the sources is their push into exclusive buy now, pay later, or BNPL integrations with specific merchant partners.
Oh, the BNPL stuff is fascinating.
It is, because the data shows that for some of these merchants, adding that Venmo BNPL option directly at checkout drove a 10% plus increase in total sales volume. It proves that layering credit and lending services directly into the moment of purchase is a massive conversion driver.
It absolutely is.
Yep.
And pushing BNPL and driving debit card adoption are fantastic immediate fixes to prop up the margins today.
Right, today.
But Enrique Lores is playing a much longer game. To survive the next decade, just monetizing Venmo isn't going to be enough. PayPal has to fend off some of the most aggressive, well-capitalized tech titans on the planet. And to do that, they have to execute a massive technological leap, which they are currently funding through a very painful corporate restructuring.
Let's break down that restructuring first, because it is significant. Lores is actively trimming 3 entire layers of middle management.
3 layers.
Yeah. They're taking a $120 million to $140 million charge in the second half of this year just to execute the layoffs and reorganization. But the long-term math is that this will unlock at least $1.5 billion in gross run rate savings over the next 2 to 3 years.
It's very aggressive corporate surgery.
Mm-hmm.
But those savings are not just going to drop to the bottom line to inflate profits. Management is taking that $1.5 billion and pouring it directly into research and development for what they're calling agentic payments and AI commerce.
Okay, I have to call a timeout on agentic payments.
Let me stop. Fair enough.
Because that sounds suspiciously like earnings call buzzword bingo. You just throw AI and agentic into a sentence to appease tech investors who desperately want to hear about artificial intelligence. What does an agentic payment actually mean for the listener? Does PayPal really have the engineering chops to build a technological moat here?
It's a valid skepticism. But the concept itself is mechanically sound. An agentic system means an AI acts as your autonomous agent. So Lores' vision is to strip every conceivable point of friction out of the checkout flow.
Okay.
Instead of you navigating a website, finding an item, entering your shipping address, and typing in a credit card number, the AI buying assistant does the negotiating and routing for you.
Oh, wow.
Right. It relies heavily on passkeys and biometric identity verification. The ultimate goal is that your face or your thumbprint authorizes the transaction instantly, and the underlying AI handles the complex payment routing in milliseconds.
So they want to become the invisible, frictionless identity layer underneath all internet commerce.
Exactly.
But here's the massive roadblock with that. Aren't Apple and Google already doing exactly that? I mean, think about the last time you bought something on your phone. You probably just double-clicked the side button, and Apple Pay used Face ID to handle the rest.
Yep, it's seamless.
Apple Pay is integrated directly into the hardware we all carry in our pockets. PayPal is facing severe competitive threats from those device wallets. Not to mention Shopify dominating merchant backend software, the looming rise of stablecoins for instant settlement, and even regulatory investigations in the UK regarding card routing fees. They have so many headwinds.
The market headwinds you just listed are fierce.
Yeah.
And Apple and Google possess a massive distribution advantage because they own the operating systems and the hardware. But PayPal's strategic counterargument is interoperability.
Interoperability.
Right. Apple Pay works flawlessly, but only if you are in the Apple ecosystem. PayPal's agentic identity network is being engineered to work seamlessly across any device, any browser, any merchant platform, and any operating system. They are betting that merchants and consumers will eventually want a universal standard of trust that isn't locked behind Apple's walled garden.
And clearly the PayPal board believes deeply in this vision, because the ultimate show of confidence isn't a slick slide in a pitch deck, it's rejecting a mountain of guaranteed cash.
Ah, yes. The takeover bid.
Right. The sources reveal the board recently rejected a massive unsolicited takeover bid from Stripe and Advent International. We are talking about a $53 billion offer, pricing the stock at $60.50 a share.
And rejecting that offer is the defining context you need to understand this entire earnings print. When a board walks away from a $53 billion private equity lifeline right in the middle of a messy turnaround, they are sending a very, very clear signal to the market.
Which is?
They are stating unequivocally, we believe our AI roadmap and our Venmo monetization strategy will create significantly more value than what you are offering to buy us for today.
Which brings us full circle right back to where we started, the optical illusion. The duck or the rabbit?
Precisely. Because when you look at the math in PayPal's Q2 print, you can easily see the duck. A legacy tech company executing a $1.5 billion stock buyback, using financial engineering to artificially inflate earnings per share and buy time, all while their core branded checkout margins get slowly squeezed to death by enterprise competitors.
Or you can look at the exact same data points and see the rabbit. You see a company successfully trimming the bureaucratic fat, funding a high-stakes AI product pivot with their own cash flow, and watching their Venmo monetization strategy just explode with 50% growth in debit users, setting the stage to dominate the next decade of digital commerce.
Yeah, your conclusion really depends on what timeline you're investing on and how much faith you place in the execution capabilities of Enrique Lores and his restructured management team.
So why should all of this matter to you, listening right now? Whether you're a financial analyst trying to value a legacy fintech stock, a software developer watching the AI commerce space evolve, or honestly, just someone who taps a Venmo card to buy a coffee. You're watching a defining battle of the modern internet. You are watching a tech giant fight tooth and nail to remain a verb, rather than becoming a relic of early e-commerce.
It's the classic innovator's dilemma playing out in real time on a massive global scale.
It really is. And I want to leave you with one final, slightly provocative thought based on the data buried in these sources.
Yeah.
We spent a lot of time today talking about growth, about AI identity networks, and about shifting margin mixes. But there is one metric we barely touched on: active accounts.
Right.
PayPal's total active user base is sitting totally flat at 439 million. Zero growth.
Completely stagnant.
Stagnant. They rejected a $53 billion lifeline to bet on their own AI vision. They are using their massive cash flow for stock buybacks instead of pouring it into aggressive user acquisition. If that user base remains flat, and if this ambitious AI checkout revolution doesn't scale fast enough to offset the sheer hardware dominance of Apple and Google, does PayPal risk becoming the next Yahoo?
Oh, that is a chilling comparison for any executive in Silicon Valley.
But think about it mechanically. Yahoo was the ubiquitous internet tool. They won the early web by being the default portal. But ultimately, they lost the platform war, they failed to adapt to mobile fast enough, and they faded into a legacy brand.
And PayPal undeniably won early e-commerce.
They did. They were the undisputed king of the desktop internet checkout. But the water is getting murky. The X-ray isn't clear anymore. Keep an eye on those active accounts over the next few quarters, and let's see if this EPS magic trick buys them enough time to build a lasting transformation.